Secured loan. A secured loan is backed by something valuable the borrower owns, like a house, a car, or savings in an account. That asset gives the lender protection. So these loans usually come with lower interest rates and larger borrowing limits. If the borrower stops paying, the lender can take the asset to recover the money. In practical terms, many of the biggest loans people use in daily life fall into this category because the collateral makes long repayment periods possible. Unsecured loan. An unsecured loan does not require collateral, so approval depends more on income, credit history, and the lender's confidence that the borrower will repay. Because the lender is taking on more risk, the interest rate is often higher than with a secured loan. These loans are common for everyday borrowing, especially when someone needs cash quickly for expenses that do not come with a physical asset attached. The trade-off is simple, easier to use for general purposes, but usually more expensive over time. Personal loan. A personal loan gives a lump sum that is repaid in fixed monthly payments. People use it for medical bills, repairs, travel, or other large costs. Its main feature is flexibility because it is not tied to one specific purchase. Mortgage. A mortgage is a loan used to buy property. The home secures the loan, which allows repayment over many years. It matters because it makes home ownership possible for people who cannot pay the full price up front. Auto loan. An auto loan is used to buy a vehicle, with the car usually serving as collateral. It is shorter than a mortgage because cars lose value over time. The monthly payment depends on the price, term, and interest rate. Student loan. A student loan helps cover education costs like tuition, books, and housing. Some come from governments, others from private lenders. What makes them different is that they are meant to be repaid later, often after school ends. Credit card debt. Credit card debt is revolving debt, which means the borrower can spend, repay, and borrow again up to a limit. It is useful for everyday spending, but interest can be high. That makes it convenient in the short term and expensive in the long term. Home equity loan. A home equity loan lets a homeowner borrow against the value built up in the home. It usually comes as a lump sum with fixed payments. People often use it for renovations or other major expenses. HELOC. A HELOC, or home equity line of credit, also uses the home as collateral, but works more like a reusable credit line. The borrower takes money as needed instead of all at once. It is more flexible, though rates are often variable. Business loan. A business loan is used for company needs like equipment, inventory, payroll, or expansion. Lenders look at both the owner and the business itself. It matters because many businesses rely on borrowed money to grow. Bridge loan. A bridge loan is a short-term loan that covers a temporary gap. It is often used when someone needs money now but expects other funds soon, such as from a home sale. It is useful for timing but usually more expensive. Payday loan. A payday loan is a very short-term loan meant to be repaid on the next paycheck. It is fast and easy to get, but usually comes with very high fees. That makes it one of the riskiest forms of borrowing.